Brewin Dolphin Investment Director. Janet, very good to have you with us. So as we head towards Jackson Hole, the view of CalSTRA's then, they're a little bit nervous about what they see in these equity markets. They see them as priced to perfection. Do you have that same assessment of pricing, of valuation, and does that make you nervous?
Hi, good morning, Anna. Thanks for having me. So we are overall overweight on our equity position. We have been overweight on equities for a long period of time. And the key reason is because of there is no alternative narrative. Basically, we're seeing yields being very low. And mind you, we have this QE tapering discussion and the Fed minutes showing that they are going to do it probably later this year. And still, US bond yields really barely moved. So we think that this cycle, the bond yield is going to be lower than the previous cycle. So we think that in this low yield, low interest rate environment, investors will continue to prefer equities. So that's really the key argument there. And we are at the stage of an ongoing economic cycle. So despite we're seeing some deceleration in the recent economic data, it doesn't change the fact that we are still in recovery and we're going to see growth. So in this environment, again, equities should be the preferred choice.
Okay, so low interest rate environment means there is no alternative. Tina to the fore, Janet, and that's one of the arguments for getting into equities as far as you see it. Is one of the threats to that view then that we do see higher Treasury yields? And what do you think could drive those Treasury yields higher from here? We've seen a little bit of upside over recent days, but we're still just at 1.28% on the US 10-year yield. I was looking at some views from PGIM, who were saying that they don't think that we're going to see higher yields on the back of the taper because the yields have not gone higher on the back of talk of tapering. So if the taper doesn't drive yields higher, what could?
Yes, if you look at the developments in the first half of the year, yields have gone significantly higher in a fast pace, and that's primarily because of the economic expectation of very strong growth. So this year, we're going to see US and UK growth at 7%, and we are not going to see that next year. So it seems that the peak growth is already being experienced already, and we are talking about peak growth, peak inflation, and peak stimulus. So we doubt that we are going to see yields as high as where we have been in the first half of the year, that's 175. And what we think is that there is upside for yields, given that we are likely to see ongoing economic recovery, labor going back into the job market after the extra unemployment benefit ends, and just ongoing normalization of the economy. So that, I think, is the driver for the high yields there. But given that our view is that very strong growth has already been passed, and we are going to see a transition to slower growth from here, we doubt that the yields will have a very strong upside from here. And also, people have been saying that QE tapering would push yields higher. But actually, if you look at the stimulus situation, we are likely to see peak stimulus as well this year. And going forward, there will be less supply of treasuries in the market. So the Fed is buying less bonds, but also there's also less supply of treasuries in the market. So we don't think that QE tapering would be a threat to the bond yields.
Okay, so a similar view to PGIM then, perhaps. In terms of the inflation narrative, Janet, where do you see that heading? And I'll bring things back to Europe a little bit here, and specifically the UK, because we saw some data out from the job site Indeed overnight that was talking about UK construction and manufacturing wages really flying, really increasing. I mean, just the construction sector, wages up by 6.7% according to Indeed between February and July of this year. This is really strong inflation in wages, and I wonder if lots of people look at that to see whether that's going to then push another round of inflation or entrench the inflation vibe that we have in the UK a little more strongly. What would you anticipate seeing on inflation?
Yes, that's a very catchy headline indeed. I saw that headline as well. So I think the construction industry is one of the affected industries of the pandemic. So basically, I think a lot of projects were delayed during the lockdown. And obviously, with a lot of catch-up work that needs to be done, and with a lot of the workers potentially staying home because of COVID or because they're concerned about COVID, obviously you have imbalance between the demand and supply when the economy reopens, when that work restarts. So again, that fits into the transitory inflation narrative that this year we're having so much supply bottleneck in terms of material shortages, in terms of labor, that when you also have a very strong demand all coming together this year. So what we think is that this is likely to be transitory. So of course we have to see. We believe that wages could have a bit more elevated pressure going into next year, but we think that that huge pressure, that headline 8% wage growth in the UK is likely to subside. And if you look at the work of the Bank of England, they also did some analysis. If you take out the COVID effect, if you take out the furlough effect, actually the underlying wage growth is about 3-4%. So that's our central base case, that wage growth should moderate from here.
Janet, thanks very much. Stay with us. Janet Murray.